So here's a question for you. When is the real estate dip going to happen, and how should we buy the real estate dip?
Yeah, so I think we need to tackle that question as when to buy the real estate dip, right? I think we're making the assumption that the real estate dip will happen at one point. And last Friday, if you guys didn't catch it, we made a video about whether this real estate quote unquote dip, will be a crash or a simple correction, and when it's going to happen. So I've done some more research. Daniel and I spent some more hours of research, and I believe that this will probably set the timeline for the real estate dip. So right now, there are approximately 2.3 million homeowners in forbearance for the COVID-19 because they lost their job, they've been furloughed, and many of them have declared that financially they can't make it. So
here's an objection to that, right? Because a lot of YouTubers, me, Kevin, actually being one of them, have actually said that the 2.3 million mortgages in forbearance doesn't mean a thing. Okay. Because he's saying here are his two main arguments, right? And I'm sure this is what a lot of individuals are thinking. But for one, he's saying a lot of those 2.3 million for mortgage forbearance didn't go into forbearance because they had to. Right. They did it because they were able to, right? They had the option.
Which I thought was the dumbest thing in the world.
Okay,
right?
why do you think that?
Well, here's why. Because I never trust the banks. Okay, at the end of the day, I don't trust the system. I don't trust the banks. I don't count on the banks to actually be on your side when you need them most. And especially for the fact that last month we did a video with CFPB, the Consumer Financial Protection Bureau, coming out and basically saying, hey, we need to make sure the mortgage servicers, mortgage companies are working with the borrowers to make sure that they get the best exit option as possible. And a lot of the exit options that are like favorable, and a lot of the things that me, Kevin, and some of these other YouTubers talked about, they are not always available. Like the whole idea of defer payments, meaning, if you had, let's say, 6 months of mortgage payments that have been in forbearance, it's not guaranteed that those 6 months of payments could be added to the back end of the loan, meaning you don't have to pay for it until it's refinanced or your house is sold or or your mortgage is paid for. Yeah. Those options are not necessarily guaranteed.
So here's the second argument that they're making is that government intervention will step in and bail out the average American homeowner that has their mortgage in forbearance.
Well, let's give the government a benefit of doubt. Right? Let's give the system a benefit of doubt for a sec. Okay, when did they ever execute any of these plans perfectly? And if they did, right? If they did, isn't this just kicking the can like in the inevitable down the road?
For sure.
Right. Yeah. This whether it's a correction or a crash.
So let's go back, right? Yeah. So let's go back to the dip, the real estate dip, right? You're spotting out some statistics. When is going to happen, right? So you got 2.3 million mortgage. What else we got?
So out of the 2.3 million, and I tracked two sets of data. So March 2021, it was still 2.3 million-ish people. That hasn't gone down since the last 3 months. It hasn't gone down. I would expect it to have come down to like maybe at least 1.8 million homeowners. That just tells you that the situation isn't improving for these 2.3 million people. Now, a lot of experts and economists, and I would also agree that these are subprime mortgage borrowers. And I'll get to that fact and data a little bit. But a vast majority of them probably are still in a financially difficult situation where vast majority of them are in subprime mortgages, less than 620 credit scores.
Well, here's something that many people haven't accounted for yet, right? It's just the fact that the rate of inflation, the cost of goods and services has yet to truly affect the financials of the average American household. We can't forget that because think about what has happened, right? Yes. Inflation's gone up, price of goods and services, but income has not gone up. Yeah. We need to give it a bit.
You know what also hasn't gone up?
What's up?
The fact that they didn't smash the like button. They need to bring that like button.
What was that?
I got to bring it out there. I know it's cheesy.
Come on, Graham Stephan.
We got it. Hey, there you go. That was a really weird and cheesy, awkward
for the sake of
transition.
Sam's dignity, please go and smash the like button. Because otherwise, that joke was in vain. Man, it wasn't for that.
Yeah, if that didn't work, man, that was a major flop. Nick would have to edit that out.
For sure. But here's the thing. So income has not gone up, right? But the cost of goods and service, historically speaking, we need about 3 to 6 months before we really start seeing the effects of what it does to the average American family.
And what's scary is that, and I'll go to this data now because ever since 2014, and this has been tracked by HUD, Department of Housing and Urban Development. 2014, what we saw was less people who had the credit scores between 500 and 620. Less of them were able to get the FHA financing, right? Closer to this year, 2019, 2020, and 2021, we saw an increase of individuals that have less than 620 FICO score getting approved for the FHA loan. And a lot of times these individuals also have more than 43% debt to income ratio. What does that tell you? Well, that means that they're crunched. They don't have enough to support on, and even if there's a slight change in their expenses, where it goes up or their income goes down, now they're in a potentially distressed situation.
Interesting. So here's what I think is going to happen, right? So ultimately, you're saying that FHA programs have gotten very loose, right? You've alluded to some facts, right? Do you have any other statistics that would say that FHA is almost replicating what happened in 2005, 6, and 7 with the central banking system?
Yeah. So back in 2016, I believe 2016, FHA stopped using manual review.
Okay.
Meaning that once they, especially for those that have less than 620 credit score, right? Less than 620 credit score is risky.
Very risky.
Very risky.
It's subprime, yeah.
Right. Banks have to, and so before 2016, when we were still kind of like still buzzed, right, from the 2008, 2012 market crash, FHA and a lot of mortgage companies were still manually underwriting these loans, right? Making sure that human eyes were looking at it, looking at the papers. Well, after 2016, they started doing automatic reviews. They let the computers.
So it was a lot like the mortgage industry in 2004, 5, 6, 7 with the Ninja loans, right? And the Nina loans, right? Where they just literally application came in, they automatically approved it. Mortgage brokers made their commission. Rating agencies didn't do anything, right? Mortgage-backed securities were actually a lot more subprime than they actually were. You're saying that's what's going on with FHA the last 5 years.
No. So it's not as that bad. It's not as bad. Okay.
No,
so this time it's not a credit issue. I don't think it's a credit issue as much as what we saw back in 2006 to 2008 in terms of all that growth. But what is alarming, coupled with the hyperinflation conversation, right? Because I wasn't actually thinking about that. And as price and home goods go up, will that crunch these people where they're already at that 45% debt to income ratio? And Federal Reserve, and we'll post all these charts and links down below so you guys can go check that out. But Federal Reserve, the delinquency rate for these mortgages has gone up slightly, and I believe it was like 0.5%, and it went up, and it's on a holding pattern. Now, my question is, if it wasn't for the mortgage forbearance, could that have gone up to maybe like 4 or 5%?
Absolutely, right? So ultimately, I'll play devil's advocate.
Sure, go for it.
Right? So I actually think, I do believe, I'm with you. I think the real estate dip is going to happen.
And we'll come back to the question of when, because this is a build-up of what's happening.
Well, we need to know how before we can know when.
Yeah,
right?
and go ahead and leave your thoughts down below. With all the facts and research I've done, go and comment down below. What do you guys think about this? Are we waiting for the inevitable, or what's going on? So
are we going to continue to kick the can down the road?
Right.
What do you guys think? What is Joe Biden going to do? Right, and to keep the ball rolling, right? What's going to happen here, right?
Go for it.
I agree with you on the when. Yes. I disagree with you on the how.
Well, we haven't revealed when, right?
For sure, right? Yes. But I think you and I have a clear understanding of when it's going to be, right? But I disagree on the how, right? Because here's what I believe. Let's say that those mortgage forbearance programs. Let's say that the Fed didn't come in and save the day. Maybe let's say the delinquency rate is actually a lot higher than it is.
Sure.
What ultimately happens as a result of that? Well, you have an inventory of homes that re-enter the market.
Yeah.
Right. Right now, we just have people forget the millennial generation. The millennial home buyer is the largest generation, even larger than baby boomers. We are a larger generation than the baby boomers, and we have records. And keep this in mind as well. Yes, a lot of people are saying we are hunkered by debt, but at the same time, we have more available financial vehicles to purchase a home more than ever
before.
I mean, think about we have FHA, we have
first-time home buyers,
mortgage, we have purchase
VA.
HELOC, VA. Right? I mean, there's so many different ways to buy owner financing. Where we bought our former home through owner financing.
None of these options existed prior to the 70s.
No, they did not.
Right. Prior to the 70s, either you came up with 50% down payment with a 5-year amortization, or you weren't buying a home.
Or you weren't buying a home at all, right? So we have so much available to us. My prediction, and so let's say all these homes did enter back into the market.
Right.
My theory, and this is what a lot of other YouTubers are saying, and I would actually tend to agree with this, that the buyer pool of demand is so strong right now that those delinquent homes that eventually re-enter the market will be absorbed by the existing buyers.
Yeah.
I think that is true, considering the amount that rent has gone up everywhere around the country. Just shows you how low of an inventory the housing market has really gone in the last 18 months, 24 months.
And a lot of the baby boomers didn't want to necessarily list their homes due to COVID, right?
Absolutely.
Because they're much of a danger. They're probably the most dangerous, or I would say what's the word? Exposed to danger, right?
Well, let's be real. It's like when a pandemic is happening, when something big is happening, nobody wants to make a major financial decision. Right?
Absolutely.
I mean, people don't talk about the effects of 9/11 on the average American's finances. So here's what I ultimately think the how is going to be, right? Anytime you ever see a recession or a crash or anything of that nature, it's not typically due to housing directly. If we look back in 2008, the real reason why that happened was because of the central banking system.
Yeah.
Right. There was a lot of negligence on their end, and housing just happened to be the
commodity, right?
It happened to be the asset, right? Most people don't know bubbles happen with different assets. The first bubble that ever happened, the first ever bubble crash burst that ever happened in the United States was 1797 with land. Yeah. Right. That's what happened. Yeah. So I think in terms of the how, I think the biggest thing is going to be the central banking system. I think we've got to look at two things.
Yeah. Well, hold on. So we're going to, hold on. We're going to save this video for so here's a little foreshadow for you guys. If you guys want to continue seeing our content, we're going to actually have a separate video, what will cause a dip.
For sure.
We're going to have a separate video. So we're gonna come back to the when.
Absolutely, right? But let me say one then.
Okay, go for it.
I'll give you one out of two.
Little taste, right?
Right. Sorry, guys, right? Sam's the marketer here, so we have to,
Sure.
But let me give you guys one, and this actually is the bigger one.
Okay.
I think it's going to be a liquidity ratio happening with the bank. Because here's what's going on right now. A month ago or a month or two ago, the Federal Reserve changed the way that the banks must hold in reserve in order for them to do business.
They increased the reserve rate.
They changed what's known as the SLR, which is the statutory liquidity ratio. Yeah. They went from 5% to 10%. Ooh. Initially, they lowered it because of COVID because they wanted the banks to have more room to have mortgages go into forbearance. Because guess what? In order for banks to put mortgages in forbearance, they have to have a reserve of liquidity in order for them to do that. They can't just say, hey, Bob, stop paying your mortgage. Yeah, no, they have a balance
still have
sheet.
To service.
They have a portfolio they have to manage. They have investors that they must accommodate.
Absolutely.
There's all sorts of things that must happen. So in order for the banks to be able to do that, the Federal Reserve lowered. They cut it in half.
Right.
Now that it just got back to normal levels, right? So now one has to ask, well, what is the liquidity situation going to be for banks moving forward?
Right.
Especially when the Federal Reserve stops pumping money into the central banking system.
Yes.
What is that going to look like?
Yeah.
I think that's going to be the big one.
And so there's a little foreshadow for you guys. We'll have a whole entire separate video about what will cause a real estate dip. Now here comes the when, right? Yes. I think the closest thing I can find, and I'm always researching, I'm always looking for other possibilities here, but the CFPB has asked the Consumer Financial Protection Bureau, which is an agency, it's a federal government agency that is designed, created in 2012 as part of the Dodd-Frank Act, to protect the individual consumers from these evil, predatory banks. Here's what they asked the mortgage companies to do: is to stop any foreclosure actions until 2022.
Yes.
So it's basically saying, hey, just at least stop the bleeding until 2022. Could we see a potential foreclosure wave? I think CFPB quietly knows that it could happen. Like they secretly think that it's going to happen, and they want to stop it somehow, but they don't want to make it obvious. Yeah. Right? They don't want to create a self-fulfilling prophecy kind of a situation. So do I believe that it's going to be a wave? I think it's going to come in tranches. I think it's going to come in one wave and then the next wave, and it's not going to be one big one. I think it's going to be smaller trickles. And 2022 we're going to see a lot more distressed inventories. We're going to see a lot more REOs, real estate owned properties. These are properties owned by banks. We're going to see a lot more short sales. We're going to see a lot more foreclosures happening. But I am very curious to see the new type of real estate investing that's going to happen. I think in the next 5 years, which we'll cover what to buy during the real estate dip. So we'll have a separate video on what to buy during the real estate dip. So we got to pay attention to 2022.
So in regards to when, that's when you think it's going to happen.
Yeah. So 2022 and on. A lot of people right now think that we're in like the February, or we're in the 2016 or 2006 mode, which I don't necessarily agree. We're I think this is a completely different situation than what we've seen in 2008 and 2012. But I think 2022, and I think we're going to see the rock boat a little bit in late 2022.
The boat rocked a little bit, yeah.
Rock boat.
Sure.
Rock boat,
so I'm gonna say third quarter of 2022.
Okay.
I've been saying for the longest. I've been saying since 2016, third quarter of 2020. Yeah. That's what I've been saying. And sure enough, right, because it usually takes about 6 months for the market to really react to what happened. Sure enough, March of 2020, COVID hits. Yeah. And I said, here we go. Yeah. This is it. You add 6 months to March. Guess what you get? September of 2020. Guess what September of 2020 is? it's the third quarter of 2020. I've been saying it for years. I said, here we go. What I did not account for was the amount of government intervention. What I did not account for was the hundreds of billions of dollars that the Federal Reserve were going to purchase in mortgage-backed securities, which, by the way, that's what propped it up a lot of the housing market in terms of artificial boost. The $7 trillion, or now approaching $8 trillion in the federal balance sheet. I did not account for the three waves of stimulus that were going to come in, the amount of inflation that the administration was going to input to keep the economy alive, so to speak. I did not see that coming. But I do agree with you, Sam. I think it is going to be third quarter of 2022, not just because of the foreclosure, but because of the liquidity ratios.
Unless there's another government intervention.
Which I think there is. I actually think there's going to be a fourth stimulus check, a fourth round of stimulus. I think things are being set up right now for the Biden administration to do a fourth stimulus round.
Yeah, and of course they want to look good. So, so that being said, guys, thanks. We'll kind of wrap things up here, but we're gonna continue this video with the next video, and hopefully by the time you watch this, we already released our next video. So the next video we're gonna probably do is what we'll call the real estate dip. Daniel kind of alluded to a little bit as far as going back to the old reserve rate, as far as what the banks are required to keep in terms of cash. We'll go talk about the cost, and then next week we'll start to talk about what to buy, because I think the days of buying single family is over, and I'll explain why. I'll leave my thoughts. Daniel probably disagree, but we'll talk about what to buy during the dip, because I think it may shock you. So we'll see you in that video, guys. Subscribe, leave your thoughts below.
Leave any comments of what you think. Do you agree with us? Do you disagree with us? What do you guys think? How do you think the dip's gonna happen? Leave your thoughts even before we release the video, and then we'll see what we can do. But see you guys.
See you in the next video.